Hello everyone. Welcome to a short lesson video on the topic Standard Costing for Cambridge A-Level Accounting. In this video, we will understand the different fixed overhead variances and solve an example on the same. Before we proceed, please note, abbreviations are used in this presentation only due to space constraints. Abbreviations are strictly not allowed in the Cambridge exams. Fixed overhead variances give us the reasons for the difference between the amount of fixed overhead actually incurred and the amount that is charged to production through overhead absorption rates. Putting this statement in equation form, we have the actual amount of fixed overhead incurred, but this differs from the amount of fixed overhead absorbed in the production through overhead absorption rate, which is nothing but the amount that the producer charges as overhead to the customer while selling the product. There could be many reasons for this difference. Either the factory worked less efficiently than budgeted, or it worked more efficiently than budgeted, which is great. Maybe the factory under or overutilized its capacity, or it could be that the actual overhead absorption rate is less or greater than the budgeted overhead absorption rate. Whatever the cause, we can find out with the help of fixed overhead variances. This is a chart showing the types and subtypes of fixed overhead variances. If you like, you can pause the video for a minute and go through it. I'll discuss this chart later in the video. For now, we will look at each of these variances individually. We'll start with the fixed overhead efficiency variance. Fixed overhead efficiency variance, as the name suggests, analyzes the efficiency of the labor in the factory. It identifies the difference between the hours that should have been taken by labor and the number of hours that were actually taken. Formula wise, this can be expressed as hours that should have been taken by labor for actual output minus the actual hours taken by labor, the whole thing multiplied by the standard fixed overhead rate. Or I can write this as standard hours per unit multiplied by the actual production in units minus the actual hours per unit multiplied by the actual production in units, the whole thing multiplied by the standard fixed overhead rate. One very important thing to note is that even if I reverse the order of the brackets, the answer will not change, it will remain the same. And this holds good for all the formulas of standard costing. Next, we will look at the fixed overhead capacity variance. So the fixed overhead capacity variance identifies the difference between the maximum hours that the factory can work for and the number of hours actually worked. The formula is fixed overhead capacity variance is equal to maximum hours that the factory can work for minus the hours actually worked, the whole multiplied by the standard fixed overhead rate, or standard hours per unit multiplied by the standard production in units minus the actual hours per unit multiplied by the actual production in units, the whole thing multiplied by the standard fixed overhead rate. Next, we take a look at the fixed overhead volume variance. The word volume means quantity or the number of units produced. Therefore, the fixed overhead volume variance identifies the difference between the budgeted production in units and the actual production in units. Let's take a look at the fixed overhead volume variance formula. It is budgeted production in units minus the actual production in units, the whole thing multiplied by the standard fixed overhead rate per unit. It is extremely important to note here that since the items in brackets are in units, the standard fixed overhead rate is also per unit. Conversely, if the items in brackets were in hours, the standard fixed overhead rate would also be in hours, as was the case in the fixed overhead efficiency variance and the fixed overhead capacity variance formulas. Put simply, this formula looks like this. Standard production in units minus the actual production in units, the whole thing multiplied by the standard fixed overhead rate per unit. Coming to the fixed overhead expenditure variance now. This variance identifies the difference between the budgeted spending on fixed overhead and the actual spending. We must look at the formula now. The fixed overhead expenditure variance is the budgeted fixed overhead expenditure minus the actual fixed overhead expenditure. We can express this as standard rate into standard hours minus the actual rate into the actual hours. Or I can say that it is the situation envisaged by management while preparing the budget at the beginning of the year minus the actual situation. The last fixed overhead variance that we have to study under your syllabus is the total fixed overhead variance. The total fixed overhead variance identifies the difference between the standard fixed overhead per unit absorbed by the actual production, which is calculated in the flexible budget, and the actual fixed overhead incurred. We have already seen that the standard fixed overhead per unit absorbed by actual production means the amount charged to the customer as overhead. So the formula for the total fixed overhead variance is total fixed overhead variance is equal to flexible budget fixed overhead minus the actual fixed overhead. Now what do we mean by the flexible budget fixed overhead? Flexible budget fixed overhead means the standard fixed overhead rate per unit multiplied by the actual production in units, from which we will subtract the actual fixed overhead rate per unit multiplied by the actual production in units to arrive at the total fixed overhead variance. Therefore, we see that the total fixed overhead variance occurs either because the time actually taken or the rate actually paid differs from the budgeted time and rate, and this difference is given to us by the fixed overhead expenditure variance. Or it occurs because the quantity actually produced does not match the quantity specified in the budget, and this difference is given to us by the fixed overhead volume variance. The fixed overhead volume variance occurs either because the capacity at which the factory was working does not match the capacity in the budget, and this difference is given to us by the fixed overhead capacity variance, or because the efficiency at which the labor was working was not the same as the efficiency specified in the budget, and this difference is given to us by the fixed overhead efficiency variance. Let us now solve an example on the fixed overhead variances that we have learned. We have been given some information for MPLC for November. We have been told that MPLC absorbs fixed overheads on the basis of direct labor hours. That means we will take into consideration the direct labor hour rate when calculating the fixed overhead cost for MPLC. The direct labor hour rate is given to us, it is $4.5. We have been told that 10 hours will be required per unit. Therefore, per unit, the fixed overhead budgeted rate is 10 into 4.5, that is $45. Remember that this is the budgeted fixed overhead rate per unit. Keep this figure in mind. We'll use it later for our calculations. As per the budget, 1000 units were supposed to be produced. Therefore, as per the budget, the total fixed overhead should have been 45 into 1000, that is $45,000. The actual fixed overhead cost was $38,250. Actual hours were 8,500 and 900 units were produced. We have to calculate in part A the expenditure variance. So let's start. So this is part A. Fixed overhead expenditure variance is equal to standard rate into standard hours minus the actual rate into actual hours. That means the expenditure envisaged by the management minus the actual expenditure. Budgeted hours per unit are 10 and budgeted number of units is 1000. Therefore, total number of budgeted hours is equal to 10 into 1000, that is 10,000 number of budgeted hours or 10,000 standard hours. Standard rate we already know is $4.5 per direct labor hour. So we'll write standard rate $4.5 multiplied by number of standard hours, that is 10,000, This is giving us the standard expenditure on fixed overhead. From this, we will subtract the actual expenditure on fixed overhead. Let us see how much that is. Actual fixed overhead cost is $38,250. So we'll write 38,250 here. Therefore, we have 45,000 minus 38,250. So expenditure envisaged by management was to be 45,000, but actual expenditure was only $38,250. Therefore, there is a variance of $6,750, and this variance is favorable because the actual expenditure is less than the expenditure expected by the management. Favorable variance is denoted by the letter F in brackets. In part B, we have to calculate the fixed overhead capacity variance. So this is part B. Let's write the formula as usual. Fixed overhead capacity variance is equal to standard hours per unit multiplied by the standard production in units minus actual hours per unit multiplied by the actual production in units, the whole thing multiplied by the standard fixed overhead rate. So we know that standard hours per unit is 10 and the standard production in units was 1000 units. This was the production expected by the management. So we'll write 10 hours per unit multiplied by 1000 units. This will give us the total number of budgeted hours. From this, we will subtract the actual hours taken, that is the actual hours per unit multiplied by the actual production in units. 8,500 actual hours were taken. So we'll write minus 8,500, close the bracket, multiplied by the standard fixed overhead rate, which as we have seen before is $4.5. So we'll write 4.5 here. Now let's solve this. We have 10,000 minus 8,500 multiplied by 4.5. We get 6,750. Now let us understand whether this fixed overhead capacity variance is favorable or adverse. As per the budget, the factory has the capacity to work for 10,000 hours. But the factory only worked for 8,500 hours. That means the factory underutilized its capacity, which is not a good thing for the company, and therefore this $6,750 is an adverse variance which will be denoted by the letter A in brackets. Part C involves finding out the fixed overhead efficiency variance. So the formula is fixed overhead efficiency variance is equal to standard hours per unit multiplied by actual production in units minus the actual hours per unit multiplied by the actual production in units, the whole thing multiplied by the standard fixed overhead rate. So essentially this is hours that should have been taken for the actual output as per the budget minus the actual hours taken. Standard number of hours per unit as per the budget is 10 and the actual production in units is 900. So we'll write 10 multiplied by 900. From this we will subtract the actual hours taken. Actual hours taken, as we have already seen, are 8,500. So we'll write 8,500 here multiplied by the standard fixed overhead rate $4.5. So multiplied by 4.5. Solving this equation, we get 9,000 minus 8,500 multiplied by 4.5. So we get $2,250. But is this favorable or adverse? As per the budget, the labor should have taken 9,000 hours to complete the production, whereas labor only took 8,500 hours, which means the labor was very efficient. It is a good thing for the company and therefore this is a favorable variance which will be denoted by the letter F in bracket. Next in part D, we find out the fixed overhead volume variance. The formula for fixed overhead volume variance is standard production in units minus actual production in units, the whole thing multiplied by the standard fixed overhead rate per unit. As per the budget, the management had estimated that the factory would be able to produce 1000 units. So this is the standard production in units. But the factory was only able to produce 900 units. So this is the actual production. So this becomes 1000 minus 900 multiplied by the standard fixed overhead rate per unit. So how much is the standard fixed overhead rate per unit? It is $45. The figure that I had asked you to take note of earlier in the video. Multiplying the bracket by 45, we get $4,500. Now let us see whether this variance is an adverse or a favorable variance. As per the management's estimate, 1000 units should have been produced by the factory, but the factory was only able to produce 900 units. This is not a good thing for the company, and therefore this is an adverse variance which will be denoted by the letter A in brackets. In the last part of this question, we have to find out the total fixed overhead variance. So let's compute that. We'll write the formula first. Total fixed overhead variance is equal to the standard fixed overhead rate per unit multiplied by the actual production in units minus the actual fixed overhead rate per unit multiplied by the actual production in units. Remember that figure I asked you to keep in mind? $45. And what is this $45? Standard fixed overhead rate per unit. And the actual production in units is 900. Accordingly, we'll write 45 into 900. Now this is the flexible budget fixed overhead. From this we will subtract the actual fixed overhead. Actual fixed overhead, as we have already seen, is $38,250. Therefore we will write minus 38,250. Solving this further, we get 40,500 minus 38,250, which is equal to $2,250. But is this variance favorable or adverse? As per the flexible budget, the total fixed overhead should have been $40,500. But actually, the total fixed overhead expenditure is $38,250 only. That means the actual figure is less than the flexible budget expenditure, which is a good thing for the company, and that is why this is a favorable variance denoted by the letter F in brackets. With that, we have completed part E of the question, and that means we have solved the entire question. So that was a brief discussion on fixed overhead variances.